Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, and it's September 18th here. We got a bit of economic news releases over this week, but the big one item this week will be the FOMC meeting, which will begin tomorrow, and then they give their announcement on Wednesday. So the big thing for that will be obviously there's almost pretty much a zero chance of a rate hike at this meeting here. Fed funds futures for December's meeting are showing about 56% chance. Now, the big item that they're really going to be looking at is the unwinding of the $4.5 trillion balance sheet that they've accumulated during the quantitative easing years from '08 to 6 or 14. So what they're looking for is when they're going to begin this, how about, or by how are they going to go ahead and start unwinding this. Now, some projections are that what they'll do is they're not so much selling. What they're going to be doing is they're going to be reducing their amount that they're currently buying. So on a monthly basis, they're buying Treasury mortgage-backed securities, all these different debt. And what they're doing is, so instead of buying more, keeping that same pace or higher, they're just simply going to reduce that amount of purchases. And some of the projections so far are right around $10 billion less, beginning at $10 billion less, and then they'll probably gradually, increase that deficit so much, or that lessening of the purchasing in that category there. But today we got the NHB Home Builders Index for the month of September. So we had in August 67, and it dropped down to 64 in September. So what this is, it's a representative of the confidence level of home buyers, or not home buyers, home builders out there. And obviously we see it dipped a little bit. Now part of it could be the hurricanes, or part of it also is we're getting into the fall season, which would tend to be a lot of places in the U.S. that they're going to kind of stop construction when you're talking about heading into winter into the Midwest, Northeast areas. So, and of course, some parts we get a lot of rain, so a lot of them may not want to be building during those times as well. So we kind of start getting into the slower season for home building, as we all know here. So that's kind of dipping into the headline news. The stock market's up. It's kind of shrugging off a lot of the that all-time highs on all three indexes. The Korean thing, nothing's really happened for a few days on that, so those have been kind of shrugged off. So they're just kind of keeping moving. Now they're going to obviously be taking a lot of their big Q, as we had mentioned, from the FOMC on Wednesday. There'll be some speculation. You prepare tomorrow. There'll probably be some preparations, maybe they might kind of hold back tomorrow, just kind of get themselves ready for it, because most of the time they'll kind of go more conservative than just before the Fed announcement, in case there's any surprises. So just prepare for that. Also, just kind of throw this out there, I saw that the U.S. hit the $20 trillion debt mark. Obviously, about half of that was accumulated during the last decade. So obviously, we got some work to do to try to bring that down, obviously. So I thought that was a interesting tidbit of news that I thought I'd share there. Here's the bond market. As you can see, we got the 25-day moving average here. We got the 50-day moving average here. We are currently down about 11 basis points, so we're pretty much on the verge of not having worse pricing compared to what we had on Friday. So, we're right there on the verge of having worse pricing compared to then. But as you can see here, we're just touching out the 50-day moving average. We're at the bottom of this channel right here, and if we break below this, obviously there's a big jump here. We could probably drop all the way down to here, which would be another 40 basis points. So hopefully we can keep this 50-day moving average, keep us above this before rates even worsen more. So that's nearly a half a point in cost that we can go up if we don't hold this here. Same thing is kind of true to the 10-year Treasury. We got the yields here. We got the 25-day moving average here, 50-day moving average here. We're touching up on the ceiling of the 50-day moving average here, and if it does break above that, we got again a pretty big jump here where it could go up even higher here. Probably closest thing would be right around this 200-day moving average, and then of course about the 238 range, in this range here, that could reach. And of course, what that means is rates go up as a result. But right now the rates are a little bit higher, I would say, than what we had on Friday. And that pretty much wraps it up. If you guys want to see more updates throughout the day, just come over to Twitter. I do post throughout the day on Twitter at Mike Bjork is my handle. And I hope you guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.